Yes, hope you had your lunch. Had lunch. I also had my lunch. Sorry, client calls are there. So I was late by which I could not avoid. So shall we start with section 50 series? Everybody, seems some people are yet to join. First, I will start with section 50B, slum sale. Now, whenever business as a whole is sold for lump sum consideration, then we call that concept as slum sale. Let's say, like I am having one business, real estate business. I have an option. Either I can sell asset by asset or I can sell business as a whole. So if business as a whole is sold for lump sum consideration, okay, then that concept we call as slum sale. That means we are not ascertaining individual assets and liabilities. What is value of this asset? Value of what is the value of this asset? How much is this liability? How much is that liability? We are not differentiate. Okay, so what we are doing, like instead of valuing individual assets, we are valuing business as a whole, and we are selling business as a whole for lump sum. We call that concept as okay. So in case of slump sale, how to calculate capital gains? Because if we transfer individual asset, it is easy to calculate capital gains. But here we are not selling individual asset, we are selling business as a whole. So in this case, full value of consideration is equal to fair market value of capital assets transferred or lump sum consideration, whichever is higher. That higher amount will be considered as full value of consideration. Are you able to understand? So whatever the capital assets that we transfer during the slump sale, their fair market value or lump sum consideration that we are receiving, whichever is higher is to be taken as full value of consideration. Well and good, sir. What is to be taken as cost? In case of slump sale, cost is equal to net worth. Sir, what do you mean by net worth? Net worth means total value of total assets minus total value of total liability. Total value of total assets minus total value of total liability. Sir, how to calculate total value of total asset? If it is depreciable asset, then we will consider book value. If it is non-depreciable asset, then we are going to consider written down value. Next, if it is section 35 AD asset, section 35 AD means, you know, right, specified business. In case of specified business, 100% of the expenditure is allowed as deduction, both revenue expenditure and capital expenditure. So for section 35 AD asset, you will consider value as. Last one is self-generated asset. For self-generated asset, also you will consider value as. Are you able to understand? So very simple. In case of slum sale, you are not selling individual assets, you are selling business as a whole. So we will calculate capital gains for business as a whole. Full value of consideration is equal to fair market value of capital assets transferred or lump sum consideration, whichever is higher. Next, cost of acquisition is equal to net worth. Net worth means total value of total assets minus total value of total liability. How to calculate total assets? If it is depreciable asset, consider book value. If it is not, sorry, if it is depreciable asset, consider written down value. If it is non-depreciable asset, consider book value. If it is self-generated asset or 35 AD asset, you will consider value as 0. Similarly, for non-depreciable, I am sorry, I have written wrong here. You guys are there, but you are not responding. For depreciable asset, written down value na. For non-depreciable asset, book value. In a flow, I told something wrong. You are not pointing it out. Now, see, in case of non-depreciable asset, if any revaluation is done, we should ignore revaluation. Revaluation amount is to be ignored. Okay, you should not consider revaluation amount. That needs to be. Sir, how to calculate period of holding? Here, we are not transferring individual asset, we are transferring business as a whole. So, we will calculate period of holding for business. Are you able to understand? That means from date of commencement up to date prior to date of transfer. That period we call as period of holding. So if business is in existence before 23rd July for more than 36 months, it is long-term capitalist. If business is in existence for less than or equal to 36 months, then it is short-term capitalist. On or after 23rd July, there are only two categories. So that's why on or after 23rd July 24, criteria is 24 months. If business is in existence for more than 24 months, classified as long-term capital asset. If business is in existence for less than or equal to 24 months, classified as short-term capital asset. Are you able to understand? That is the next. Indexation benefit is not available in case of sale. See, we cannot calculate indexation because we are not transferring individual asset, we are transferring business as a whole. So indexation benefit is not available while calculating capital gains in case of. This is the concept relating to slum sale. No need to determine period of holding na sir, since indexation is not available. Even though indexation is not available, we need to classify whether it is long-term capital gain or short, because tax rates will change. For classification of long-term capital asset or short-term capital asset, we need to calculate period of holding. Okay. Section 50C, favorite section, ICA's favorite section. You should listen. See, if stamp duty value is greater than 110% of actual consideration, in that case, like full value of consideration is equal to stamp duty value. If stamp duty value is less than or equal to 110% of actual consideration, in that case, actual consideration will be taken as full value of consideration. Are you able to understand? See, how can stamp duty value actual consideration exactly it will match? That's not possible now. So up to 10% deviation is allowed. That means if difference between stamp duty value and actual consideration is up to 10%, then actual consideration will only be taken as full value of consideration. If difference is more than 10%, then in that case, stamp duty value will be taken as full value of consideration. Now, next, see, sometimes what SSC feels that stamp duty value is greater than fair market value. So before that concept, see, stamp duty value is there. on which date we need to consider stamp duty value? Generally, we will consider stamp duty value on date of transfer. But sometimes what happens, date of agreement, date of registration, both are on two different dates, and in between two dates, stamp duty value will change. On date of agreement, stamp duty value is 20 lakhs, 200 lakhs. On date of registration, stamp duty value is 240 lakhs. Now, which stamp duty value we need to take? Three conditions are there. If all three conditions are satisfied, we will consider stamp duty value on the date of agreement. If any one of the conditions are not satisfied, then we will consider stamp duty value on the date of registration. Sir, what are those three conditions? Full or part of the consideration must be received. It must be received on or before the date of agreement. It must be received by bank transaction, by any mode other than cash. If all these three conditions are satisfied, we will consider stamp duty value on the date of agreement. If any one of the conditions are not satisfied, then we will consider stamp duty value on the date of registration. Are you able to understand? So that's what. So you are finding tax very difficult in exam. The only solution is you need to practice multiple times. You need to solve as many problems as. Now, sometimes SSC feels stamp duty value is greater than fair market value. In that case, SSC is having two options, two remedies. Remedy 1, he can file case in court or appellate authority. If he files case in court or appellate authority, whatever the stamp duty value determined by court or appellate authority is there, that is final. Is final. Option 2, request income tax officer to refer case to valuation officer. Then valuation officer will do valuation. After valuation officer has done the valuation, then if valuation officer increases the amount, then full value of consideration is equal to original stamp duty value. If valuation officer decreases the value, then full value of consideration is equal to value determined as per valuation officer. That means in second case, whichever is beneficial to the SSC will be considered. If valuation officer increases the stamp duty value, then original stamp duty will be taken as full value of consideration. If valuation officer decreases the value, then whatever the decreased value by valuation officer, that will be taken as full value of consideration. Is it clear? Now, sorry, I'm getting client call. Section 50 CA. Section 50 CA means it is applicable in case of transfer of unlisted shares or unquoted shares. So whenever unlisted shares are transferred or unquoted shares are transferred, if actual price is less than fair market value, in that case, full value of consideration is equal to fair market value. Let's say Umasankar Private Limited, one company is there. I wanted to sell the shares. Actual price I sold is 80 rupees, but fair market value is 140 rupees. Intentionally, I am selling at low price so that I can avoid payment of capital gain tax. So in this case, 140 rupees will be taken as full value of consideration. Is it clear? There is one more section which I need to discuss, section 50B. Capital gains in case of transfer of capital assets by power sector undertaking following straight line method of depreciation. So generally power sector undertakings, they have two options. Either they can follow straight line method or they can follow written down value method. If they follow straight line method, they need to calculate depreciation on straight line basis. But see, if they follow straight line method, they will calculate depreciation for each asset independently. But if they follow written down value, they need to calculate depreciation for group of assets, which is also called as block. Okay, I will take one example. Let's say asset cost 30 lakhs, useful life 10 years. So how much is written down value after 2 years? We can calculate. Depreciation method is SLM. How much will be the depreciation? Cost is equal to 30 lakhs less depreciation. How much? 30 lakhs divided by 10 into 2 years, 6 lakhs. Written down value will be 24 lakhs. Am I correct? Now whatever the written down value 24 lakhs is there, from such written down value, three options are there. Option 1, option 2, option 3. Option 1, sold. Asset is sold for 20 lakhs. Then there is a surplus or shortfall. There is shortfall. How much is shortfall? 4 lakh rupees. This will be considered as terminal depreciation and it will be debited to P&L account. Case 2, it was sold for 27 lakhs. So is there shortfall or surplus? Surplus. How much is surplus? 3 lakhs. This surplus will be considered as PGBP. Terminal depreciation, it will be debited to P&L account. Option 3, it was sold for 32 lakhs. How much is surplus? Surplus is 8 lakhs. Na? So out of 8 lakhs, whatever the depreciation that we have claimed earlier, how much is the depreciation that we claimed earlier? 6 lakhs. So out of 8 lakhs, 6 lakhs will be considered as PGBP income. Balance 2 lakhs, it will be considered as capital gains. Think logically, asset is purchased for 30 lakhs. It was sold for 32 lakhs. So in the year of purchase only, if it is sold, we would have got 2 lakh rupees extra income. Na? So that's why it is earmarked as capital gains. Is it clear? So this is about section 50A. Then we will discuss exemptions. Exemptions 112A, 111A, tax rates. These three concepts are pending. So shall we start discussing exemptions? People are getting sleep, had full lunch and came to live class. Hi Sai Kiran, tell. Section 50 CA we discussed na 50 CA. In case of unquoted shares, we have discussed. I am good Sai Kiran, hope you are also fine. Next we will discuss exemptions. First we will discuss about section 54. What is the combination under section 54? Combination under section 54 is residential house property to residential house property. Section 46, I think it's buyback, na? So you want me to discuss buyback as well, Charan? Actually, there is some time gap between you and me because of internet. Okay, at last, if I have time, I will discuss buyback also. Yes, section 54. What is the combination residential house property to residential house property? That means when you sell residential house property, you will get capital gains. Now, those capital gains, if you make reinvestment in new residential house property, you can claim it as exemption under section 54. Are you able to understand? Now, see, if you want to claim exemption under section 54, this benefit is available only for individual or HUF. Company sold building. Can company claim exemption? No. Partnership firm sold building. Can partnership firm claim exemption under section 54? No. So who can claim exemption under section 54? Only individual or HUF. What is the combination residential house property to residential house property? Next. Whatever the residential house property that you are selling, it must be a long-term capital asset. Then only exemption under section 54 is available. If capital asset transferred is short-term capital asset, exemption under section 54 is not available. Are you able to understand? So only in case of long-term capital asset, exemption under section 54 is available. For short-term capital asset, exemption is not available. So you sold residential house property, you are making reinvestment. You are making reinvestment in new residential house property. Now this new residential house property can be either purchased or it can be constructed. New house property can be purchased or new house property can be constructed. What is the time limit? The time limit available for purchase or construction of new residential house property is, see, date of transfer is there now. From date of transfer, within 2 years you can purchase new house property, or from date of transfer within 3 years you can do construction of new house property. Next, sir, can we do construction before also? Yes, you can start construction before commencement, but construction should be completed within 3 years from date of transfer. Similarly, like you can enter into agreement, you can have all the transactions, but purchase should be completed within 2 years from the date of transfer. That is time limit for reinvestment. Next, amount required to be reinvested. So what is the amount that you need to reinvest? Amount required to be reinvested is gross capital gain. Are you able to understand? Next, sir, how much exemption is allowed under section 54? Exemption under section 54 is equal to gross capital gain or 10 crore rupees, whichever is lower. That lower amount will be allowed as exemption under section 54. So amount required to be reinvested, gross capital gain, reinvestment should be made, residential house property, time limit we have discussed. For purchase, like within 2 years from date of transfer. For construction, within 3 years. Construction may start before also, but construction should be completed within 3 years. Similarly, purchase, you can purchase house property within 1 year before the date of transfer also. That means during this period, you should make purchase of house property, then it is eligible for exemption. Is it clear? Capital gains account scheme. Yes, first I will explain capital gains account scheme little later. Exemption is gross capital gain or reinvestment or 10 crores, whichever is lower. So that means what? Whatever the gross capital gain amount or whatever the amount that you have reinvested, gross capital gain or reinvestment or 10 crores, whichever is lower, is allowed as exemption under section 54. Holding period of new capital asset. This is also called as lock-in period. let's say on 10th May 2025, 2024, I sold asset. I sold residential house property. On 6th April 2025, I purchased a new house property. Purchased new residential house property. So when I made reinvestment on 6th April. From this date, for next 3 years, I should not sell. I should not sell the reinvested house property. Are you able to understand? That concept we call as lock-in period. That means whatever the amount that you invested in new house property, that will be locked. New house property cannot be transferred within 3 years from date of purchase. Are you able to understand? Now you will get doubt. Sir, what if new residential house property is transferred within 3 years? If new residential house property is transferred within 3 years, then whatever the exemption claimed earlier will be reduced from cost of acquisition on transfer of new capital asset. For example, I sold asset worth 100 lakh rupees. I made reinvestment 80 lakh rupees. Now, what will happen? Or I made reinvestment 120 lakh rupees. Now, I will claim exemption. Now, how much is exemption under section 54? Like gross capital gain 100 lakhs or reinvestment. Let's say capital gain is 100 lakhs. Reinvestment 120 lakhs or maximum allowed 10 crores, whichever is lower. Total capital gain is exempt. Now, what is the thing? Whatever the new house property that I purchased with 120 lakhs is there, this should not be transferred within a period of 3 years. Sir, what if I transfer within a period of 3 years? Let's say like after 1 year I sold for 150 lakhs. Now I need to calculate capital gains. Now full value of consideration 150 lakhs. Cost of acquisition 120 lakhs is not allowed. From 120 lakhs, whatever the exemption that you have claimed earlier, that will be reduced, and only 20 lakhs is allowed as cost of acquisition and 130 lakhs is taxable as. Are you able to understand? So lock-in period. Once you do reinvestment, from date of reinvestment for next 3 years, you should not transfer the capital asset. What if you transfer? If you transfer, then consequences on transfer of new residential house property, you are required to calculate capital gains. In such calculation of capital gains, total cost is not allowed as deduction. From total cost, whatever the exemption that you have claimed earlier, that will be knocked off, that will be reduced, and balance will be allowed as deduction. Is it clear? Capital gains account scheme. See, let's say I sold one house on 28th February 2025. I sold residential house. Now, I'm having I have option. If I want to purchase, I have 2 years time limit. If I want to construct, I have 3 years time. Am I correct or not? But in between, income tax return due date is there. 31st July 2025 has come. Now, before ITR due date, I should take decision whether I have to claim exemption or not. Because if I claim exemption, my income decreases, I need to pay lower tax. If I do not claim exemption, my income increases, I am required to pay more tax. Now, department, it gave time to me 2 years, 3 years for doing purchase or construction, but department is saying before ITR due date, I should take decision whether to claim exemption or not. So two things are spoken by department. One side department is saying I will give 2 years time for purchase, 3 years time for construction. Another side department is saying before ITR due date only you have to take decision whether to claim exemption or not. So this is final due date. Whatever the ITR due date is there, this is final due date. So before ITR due date only, you have to take decision. What is the decision that you have to take before ITR due date? Either do purchase or do construction. You don't want to do purchase, you don't want to do construction. You wanted to take extra time limit of 2 years or 3 years. Then deposit money in capital gains account scheme. Right now, whatever the amount deposited in capital gains account scheme is there, the deposited amount is eligible for exemption under section 54. Are you able to understand? That means what? See, before ITR due date only, SSC has to take decision. Either he can purchase new house or he can construct new house. Department promised it will give 2 years for purchase, 3 years for construction. Still, department is also giving time for you, 2 years for purchase or 3 years for construction. But how can departments trust you? That's why department is asking you to deposit money in capital gains account scheme before ITR due date. Whatever the amount deposited in capital gains account scheme is there, that you use it now to claim exemption under section 54. But whatever, like you are depositing money in capital gains account scheme, you are claiming exemption under section 54. Tomorrow, within 2 years, within 3 years, you should mandatorily withdraw that money and you should use that money for purchase or construction of new residential house property. Are you able to understand? So generally time limit for reinvestment for purchase 2 years, for construction 3 years. But actual due date is ITR due date only. Before ITR due date only, you have to take decision either purchase or construction. If you want enhanced limit 2 years or 3 years, right now invest money in capital gains account scheme, and using these three options, this year itself claim exemption under section 54. Now what I did, I deposited 60 lakhs in capital gains account scheme and 60 lakhs I claimed as exemption under section 54. Well and good. Now I need to use this 60 lakhs within next 2 years for purchase or within next 3 years for construction. But I did not utilize that money. There is unutilized money. So whatever the unutilized money in capital gains account scheme is there, after expiry of 2 years or 3 years, whatever the unutilized money is there, such unutilized money is taxable in the hands of SC. Are you able to understand? That is the concept relating to section 54. You can see unutilized amount in capital gains deposit scheme. Capital gain relating to unutilized amount shall be taxable after expiry of time limit. Is it clear? Now I will tell one case. I sold one residential house property in Vijayawada. Capital gain is 140 lakhs. Now I purchased two houses. One in Hyderabad, another one in Chennai. Hyderabad house is 90 lakhs, Chennai house is 70 lakhs. Now, question here is 90 plus 70, 160 lakhs. Now, both houses, can I claim as exemption? Can I claim both these houses as exemption under section 54? Yes. That means what? 1:2 ratio. 1:2 ratio means you are selling one house, you are making reinvestment in two houses. Reinvestment in two houses is possible. 1:2 ratio is allowed, but subject to satisfaction of two conditions. Condition 1, if long-term capital gain is less than or equal to 2 crores, then this benefit is allowed. Here, capital gain is 140 lakhs, which is less than 2 crores. So, you can make reinvestment in two house properties as exemption under section 54, but condition 2, only once in a lifetime. Okay, this option is available only once in a. So, these are the two conditions. Is it clear now? So what is the combination? Residential house property to residential house property. That means you sold one residential house property, you made reinvestment in another residential house property. Whatever the reinvestment made is there, new residential house property, that new residential house property should be in India, then only exemption is available, otherwise exemption is not available. Able to understand? So reinvestment should be made in new residential house property in India. I sold my house in Vijayawada. I purchased a new house in Dubai. Whether cost of new house in Dubai, can I claim it as exemption here? Not possible. Able to understand? So this is all about section 54. We discussed very clearly. Now, shall I explain next one, 54B? Just now I came to know our past president T.N. Manoharan sir. He also got Padma Shri award and he worked as president of ICAI. He is visionary. Today morning he passed away at Mumbai. So deep condolences to our past president T.N. Manoharan sir. He is pride of our nation. He was awarded Padma Shri also by Government of India. Let's pray his soul should rest in peace. Section 54. Abba. Sir, what is the combination under 54B? Agricultural land, urban agricultural land to agricultural land. That means whenever you sell urban agricultural land, on sale of urban agricultural land, capital gains will arise. Now, if those capital gains are reinvested, you can make reinvestment in whatever the capital gains are there. Those capital gains are to be reinvested either in rural agricultural land or in urban agricultural land. So whatever the capital gain amount is there, if it is reinvested either in rural agricultural land or urban agricultural land, whatever the amount reinvested, that is eligible for exemption under section 54B. Are you able to understand? Now, who can claim exemption under 54B? Only individual or HCF can claim exemption. Now, individual or HCF can claim exemption under section 54B. Under 54, only if capital asset transferred is long-term capital asset, then only exemption is available. Under section 54B, exemption is available whether it is long-term capital asset or short-term capital asset. That means whatever the urban agricultural land that is transferred is there, it can be either long-term capital asset or short-term capital asset. So capital asset transferred can be either long-term capital asset or short-term capital asset, and it is eligible for exemption under section on transfer of that urban agricultural land. If you make reinvestment amount you can claim as exemption under section 54B. Okay. Capital asset required to be transferred urban agricultural land, reinvestment should be made in agricultural land. But there is one condition. Whatever the urban agricultural land that SSE transfers is there, SSE should use that urban agricultural land for a minimum period of 2 years before the date of transfer for agricultural purpose. Then only exemption is available, otherwise exemption is not available. So today urban agricultural land transferred. From today in last 2 years, that urban agricultural land should be used for agricultural purposes. Then only exemption is available, otherwise exemption is not available. Next, amount required to be reinvested is gross capital gain. Where reinvestment should be made? Reinvestment should be made in agricultural land. It can be urban agricultural land or rural agricultural land. Next, amount of exemption, gross capital gain or reinvestment, whichever is lower. Sir, what is time limit available for reinvestment? Under section 54, you need to make reinvestment in house. If you want to purchase house, 2 years. If you want to construct house, 3 years. Sir, here I wanted to make reinvestment in agricultural land. What is the time limit available? 2 years. So within 2 years from date of transfer, you need to make the reinvestment. Now, I purchased a new agricultural land. Na? So for this new agricultural land, there is lock-in period. How much is lock-in period? Lock-in period is 3 years. That means what? Within next 3 years, I should not transfer the new agricultural land. Sir, what if I transfer new agricultural land within 3 years? In that case, whatever the exemption claimed earlier is there, that will be reduced from cost of acquisition on transfer of new agricultural land. Is it clear? What? Sai Kiran, what did you message? I did not understand. Now, Whether capital gains account scheme is available? Yes, capital gains account scheme is available. Why? Department gave time limit to reinvest 2 years. How can we reinvest in 2 years? And department only saying before ITR due date you should claim exemption. Not possible na. So before ITR due date, either purchase new agriculture land or deposit money in capital gains account scheme. Whatever the amount deposited in capital gains account scheme is there, that is available for exemption now. But amount deposited in capital gains account scheme should be used for purchase of new agriculture land within 2 years. If there is any unutilized capital gains deposit scheme amount, that is taxable after expiry of 2 years. Degree batch. What degree batch? Shall I explain section 54D? Everybody. (54D) combination is land or building of industrial undertaking to land or building of industrial undertaking. But this 54D exemption is available only in case of compulsory acquisition. What do you mean by this? Let's say land or building of industrial undertaking is compulsorily acquired by government. Now government will give compensation. Now with that compensation, SSC purchased new land or building of industrial undertaking outside the city area. Now whatever the amount reinvested in new residential like new industrial undertaking is there, that amount he can claim as exemption under section 54D. Another important point, 54, 54B. Under these two sections, exemption is available only for individual or HUF. But under 54D, exemption is available for any SSC. So, like company, partnership firm, LLP, they also can claim exemption under section 54D. And whatever the land or building of industrial undertaking is there, it can be either long-term capital asset or short-term capital asset. Sir, if we are not reinvesting full amount, then unutilized amount is taxable under capital gains. Whatever the unutilized amount in capital gains deposit scheme is there, after expiry of 2 years or 3 years, it is taxable under capital gains only, not PGBP or IFOS. Now, but there is one condition. Whatever the industrial undertaking that is compulsorily acquired by government is there, that industrial undertaking is required to be used for industrial purposes for a minimum period of 2 years before the date of transfer. Are you able to understand? So it should be used for industrial undertakings for 2 years immediately preceding the date of transfer. Very, very important. Mode of transfer, compulsory acquisition. I sold land of industrial undertaking. Can I claim exemption under 54D? No. Only land or building of industrial undertaking is compulsorily acquired by government. Then only exemption under 54D is available, otherwise not available. Next, time limit for reinvestment. See, this exemption is available only in case of compulsory acquisition. Now, morning class we have discussed. Whenever compulsory acquisition is done by government, then capital gains are not taxable in the year of compulsory acquisition. They are taxable in the year in which compensation is received. So, like the date on which compensation is received, from the date within next 3 years, you should make reinvestment. Then exemption is available under section 54D. How much is the amount of exemption? Gross capital gain or reinvestment, whichever is lower. Sir, is there any lock-in period? Yes, 3 years. Whatever the new land or building that you are purchasing, you should not transfer within 3 years. If you transfer, earlier exemption claimed will be reversed and taxable as capital gain. Next, whether capital gains deposit scheme is available? Yes, because time limit for reinvestment is 3 years. Now, before only ITR due date comes. That's why capital gains account scheme was given but whatever the amount deposited in capital gains account scheme is there, it should be used within 3 years. If there is any unutilized amount after 3 years, that is taxable after the expiry of time limit under the head capital gain. Okay. This is the concept relating to 54D. So 54, 54B, 54D, if you understand, comment yes sir, would be understood. Will you do revision series for CMA final December 25? Yes. I will start revision series for CMA final in the month of September. I will release the schedule because in August month I am doing revision for CA inter and CA final, because in September CA exams are there. In the month of September, for December, CMA inter and CMA final revision series I will start. Okay. I think Charan is sleeping there somewhere. He is not replying. Next we will discuss. Charan is also saying yes sir. So you are admitting you are sleeping. Now 54 EC. What is the combination under 54 EC? Immovable property to NHAI bonds or RECL bonds, Power Finance Corporation bonds, Indian Railway Finance Corporation bonds. Whenever, okay Charan, you are listening with more attention, I understood. I jokingly said, now, immovable property means either land or building or both. Whenever land, building or both, whenever immovable property is transferred, you will get capital gains. Now, if those capital gains are reinvested either in NHAI bonds, you know NHAI, right? National Highways Authority of India, RECL, Rural Electrification Corporation Limited, Power Finance Corporation bonds, Indian Railway Finance Corporation bonds. So whenever you do reinvestment in these bonds, whatever the amount reinvested, that is eligible for exemption. So, but maximum exemption allowed is 50 lakh rupees under section 54 EC. So that's why exemption under 54 EC is equal to gross capital gain or reinvestment or 50 lakhs, whichever is lower, that will be allowed as exemption under section 54 EC. Is it clear? Another important point. See, till now time limit for reinvestment is 2 years or 3 years, but under 54 EC time limit for reinvestment is only 6 months. Time limit for reinvestment is 6 months from date of transfer. Are you able to understand? See, time limit for reinvestment is very low now, 6 months from date of transfer. That is the reason capital gains account scheme is not available. See, within 6 months you need to make reinvestment. You are not given time limit of 2 years or 3 years. That's why under 54 EC, capital gains account scheme is not available. Are you able to understand? So, but who can claim exemption under 54 EC? Any SSE can claim exemption under 54 EC. Capital asset required to be transferred is long-term capital asset and it should be immovable property. Reinvestment should be made NHAI bonds, RECL bonds, Power Finance Corporation bonds, Indian Railway Finance Corporation bonds, amendment as per Finance Act number 2 of 24. So remember that amendment. Okay. Next. Time limit for reinvestment within 6 months, as it is, as time limit for reinvestment is very low, only 6 months. Capital gains account scheme is not available. Exemption, capital gain or reinvestment or 50 lakhs, whichever is lower. Holding period, lock in period is 5 years. See, generally under 54, 54b, 54d, time limit for reinvestment is only 3 lakh, sorry, lock-in period is only 3 years. But under 54 EC, lock-in period is 5 years. Okay, my grandfather is there, he did this only. Okay, he sold one house property, he got capital gains, he invested that money in, uh, he did not sell house property, he sold land. Land is immovable property. So he made reinvestment in NHAI bonds. For next 5 years, he should not sell those NHAI bonds. If he sells, whatever the exemption that is claimed earlier, that will be reversed and taxable as capital gains. Are you able to understand? Did you observe under 54, 54B, 54D, what happened if you transfer within lock-in period? What is the tax treatment? Earlier exemption claimed will be reduced from cost of acquisition. But under section 54 EC, transferred within lock-in period, transferred within lock-in period. Then if it is transferred within lock-in period, whatever the exemption is there, exemption will not be reduced from cost. Okay, this concept is not applicable. Whatever the earlier exemption is there, that is taxable now as capital gain. So are you able to understand? So that is the difference. Under earlier 3 sections, if new asset is transferred within lock-in period, earlier exemption claimed, it will be reduced from cost of acquisition on transfer of new asset. But for 54 EC and 54F, if you transfer within lock-in period, earlier exemption claimed, it will be reversed and taxable as capital gain in current previous year, in the year of violation. So that is the concept relating to 54 EC. So till 54 EC, did you understand? Next 54F, very very important. Preparation tips, strategies, everything will be discussed at the end of the class. Now we are in the middle of the class. If you have any generic questions, ask at the end of the class. Okay. After 54F, solve one problem relating to this, sir, please. See, with regard to 54F, I gave one problem in booster material. Let us solve this problem. Then you will get clarity. Is it fine, Charan? You can see in page number 5.14, I gave one problem relating to exemption of section 54F. That we will solve. Fine. Okay, shall I start section 54F? Very, very, very important. See, section 54F is almost similar to section 54. Okay, so whatever we discussed in section 54 is there, more or less section 54F is also like that. So what section 54F says? Combination. What is combination under 54? Residential house property to residential house property. Combination under 54F is any capital asset other than residential house property to residential house property. That is the combination under section 54F. Okay. Now, who can claim exemption under 54? Individual or HUF. Even under 54F also, exemption is available only for individual or HUF. Next. Whatever the capital asset that you are transferring, it should be a long-term capital asset. Then only 54F exemption is available. Otherwise, 54 exemption is not available. Where you need to make reinvestment, you need to make reinvestment in new residential house property. That new residential house property can be either purchased or it can be constructed. Sir, what is the time limit available for reinvestment? Time limit available for reinvestment is same time limit as we discussed in section 54. As per section 54, new house is required to be purchased within 2 years, new house is required to be constructed within 3 years. Same time limits. Whenever, let's say, I sold gold, I got capital gains, I invested this money in new house property. Okay, I can claim exemption under section 54F. Within how much time I need to make reinvestment? I should purchase house within 2 years, I should construct house within 3 years, or I can purchase house within 1 year before the date of transfer also. Are you able to understand? Same time limit. Here, change is there. Amount required to be reinvested. As per section 54, 54B, 54D, 54EC, amount required to be reinvested is gross capital gains. As per section 54F, amount required to be reinvested is net consideration. So what you need to reinvest is net consideration. Are you able to understand? So here the exemption will change. Exemption under section 54F. Exemption will be calculated in 2 steps. Step 1, amount reinvested or 10 crores, whichever is lower. Step 2, exemption under section 54F is equal to gross capital gain into step 1 divided by net consideration. This is the formula for claiming exemption under section 54F. Now, shall we do one problem with regard to calculation of exemption under section 54F? I appreciate Charan and Sinduri. You are constant from morning onwards listening to the class. Thanks for being in the live class. Otherwise, it would have been tough. I would be telling class to this air conditioner, camera, lighting. Shall we do problem? So, open page number 5.14. Now, case 1. Net consideration is 15 crores. Long-term capital gain is 7.5 crores. Reinvestment is 12 crores. What is the formula? Always don't panic. Exemption under 54F is calculated in 2 steps. Sir, can we claim exemption for 2 houses under 54F? Not possible. That benefit is available only under section 54. Okay. Actually, I have to tell this point. I will tell at the last. Meanwhile, you asked me that. So help me. Step 1, reinvestment or 10 crores, whichever is lower. How much is reinvestment in case 1? Reinvestment is 12 crores na. Reinvestment is 12 crores. So 12 crores or 10 crores, whichever is lower means 10 crores. Step 2, exemption under section 54F. It is equal to gross capital gain into reinvestment divided by net consideration. How much is gross capital gain? Gross capital gain is 7.5 crores. So 7.5 crores into reinvestment means nothing but step 1. Step 1 is 10 crores divided by how much is net consideration? 15 crores. So how much is exemption? 7.5 into 10 by 15. 5 crores is exemption under section 54F. Are you able to understand? Now, shall we do for second case? In second case, step 1, reinvestment or 10 crores, whichever is lower. How much is reinvestment? Reinvestment 15 crores. So 15 crores or 10 crores, whichever is lower means 10 crores. Step 2, exemption under section 54F is equal to gross capital gain into step 1 divided by net consideration. How much is gross capital gain? 12 crores. 12 crores into how much is step 1? 10 crores divided by how much is net consideration? Net consideration is 20 crores. So 6 crores is exemption under section 54F. Shall we do third case? Again, step 1, reinvestment or 10 crores, whichever is lower. How much is reinvestment? 8 crores. 8 crores or 10 crores, whichever is lower means 8 crores. Step 2, exemption under section 54F is equal to gross capital gain into step 1 divided by net consideration. Gross capital gain 8 crores. Sorry. Gross capital gain 12 crores. 12 crores into 8 crores divided by 16 crores. 6 crores is exemption under section 54F. Case 4 and 5. Will you do as homework? Will you do on your own? Case 4 and 5 will you do on your own? Good. Ushasri Ainala. So are you also there from the morning? Okay, good Ushasri. Sir, is there any lock-in period? Yes, there is lock-in period. Lock-in period is 3 years. That means I sold gold, I got money, I invested in house property, whatever the amount that I invested in house property. Okay, I purchased a new house. Now, new house should not be transferred within 3 years. Sir, what if I transfer new house within 3 years? If I transfer new house, on transfer of new house, I am required to calculate capital gains, capital gain 1, and whatever the exemption that I have claimed earlier using this new house, that exemption will be reversed and again capital gain is taxable. So in the year of violation, two capital gains are taxable. First capital gain on sale of house, second capital gain, whatever the exemption that I have claimed earlier, that is reversed and taxable as capital gains. So these two capital gains are taxable in the year of violation. Sir, whether capital gains account scheme is available? Yes. He gave 2 years time for purchase, 3 years time for construction. Due date is within 4 months from end of previous year. So obviously capital gains account scheme is available. You can deposit money in capital gains account scheme and you can claim exemption under section 54F. Are you able to understand? But whatever the unutilized amount is there, that is taxable after the expiry of time. So this is the concept. Next, shall we discuss section 112A or 111A? Sir, please display 54F. You can look in booster material, page number 5.14. Answer is also available here. Okay. Shall we discuss 112A or 111A? Now, there are three capital assets: listed equity shares, units of equity oriented mutual fund, units of business trust. Only if these capital assets are transferred, 112A or 111A gets attracted. If you transfer other capital asset, on transfer of other capital asset, like section 112 or 111 gets attracted. So you can remember one thing: only if there are three capital assets, then only 112A or 111A gets attracted. What are those three capital assets? Listed equity shares, units of equity oriented mutual fund, units of business trust. Any one of the capital assets are transferred, then only 112A or 111A gets attracted. On transfer of listed equity shares, or on transfer of units of equity oriented mutual fund, or on transfer of units of business trust, two conditions are required to be satisfied. They must be transferred through stock exchange, okay, and STT is required to be paid. So two conditions: first, they must be transferred through stock exchange, and STT is required to be paid. So three capital assets, two conditions. So if any one of the three capital assets are transferred, and if both the conditions are satisfied, then only section 112A or 111A gets attracted. What are both the conditions? This capital asset is required to be transferred. That means listed equity share, unit of equity oriented mutual fund, unit of business trust. That should be transferred by stock exchange, and STT is required to be paid. Then only exemption is available. Otherwise, exemption is not available. Are you able to understand? Next, see, listed equity share, unit of equity oriented mutual fund, business trust. For these three capital assets, you will determine nature, whether it is long term or short term. If the nature is long term capital asset, then section 112A gets attracted. If it is short term capital asset, then section 111A gets attracted. Sir, what is the nature? Morning class we have discussed. Before 23rd July, three categories are there. On or after 23rd July, only two categories are there. So before 23rd July, for listed equity share, unit of equity oriented mutual fund, criteria is 12 months. For units of business trust, criteria is 36 months. Okay. So on or after 23rd July 24, for all three capital assets, criteria is 12 months. If they are held for less than or equal to 12 months, short term capital asset, triple 1A. If they are held for more than 12 months, long-term capital asset 112A gets attracted. Are you able to understand? Special cost of acquisition. This is important part. What happened on 1st February 2018? Finance Minister brought section 112A or triple 1A. This is with effect from 1st April 2018. That means what? Before 1st April 2018, if you sell listed equity shares or if you sell units of equity oriented mutual fund, you are not required to pay capital gain tax. But capital gain tax was brought from 1st April 2018. So, relaxation was given. What is relaxation? Those who purchased before 1st February 2018 and transferred on or after 1st April 2018. Are you able to understand? They purchased before 1st February 2018 and transferred listed equity shares on or after 1st April 2018. They are innocent buyers. Na? See, after 1st February 2018, I know tax is there on sale of listed equity shares. But before 1st February 2018, I do not have knowledge that there is tax on sale of listed equity shares. So the thing is, those who purchased listed equity shares before 1st February 2018, they are innocent buyers. So those who are purchasing before 1st February 2018 and are transferring on or after 1st April 2018, for them relaxation was given. What is that relaxation? Special cost of acquisition is allowed as deduction. Special cost of acquisition allowed. It will be calculated in 2 steps. Step 1, full value of consideration or fair market value as on 31st January 2018, whichever is lower. Step 2, cost of acquisition is equal to step 1 or actual cost, whichever is higher, that is allowed as deduction. Is it clear? Indexation benefit is not available. That means even though capital asset is long-term capital asset, even though capital gain is long-term capital gain under section 112A, still indexation benefit is not available. So this is all about section 112A or triple 1A. So did you understand 112A or triple 1A? Shall I proceed further? Now we will discuss tax rates. Very, very, very important. Tax rates, very, very important, because before 23rd July 24, after 23rd July 24, variations are there. So please listen carefully. Long-term capital gain under section 112A, just now we have discussed. Whatever long-term capital gain under section 112A is there, it is exempt up to 1.25 lakhs. Above 1.25 lakhs, it is taxable. Sir, what is the tax rate? If listed equity shares, units of equity oriented mutual fund, units of business, If they are transferred before 23rd July 2024, then tax rate applicable is 10% flat rate. If they are transferred on or after 23rd July 24, then tax rate applicable is 12.5% flat rate. So very simple. Overall, for entire 24-25, exemption available is 1,25,000 rupees. Before 23rd July, if capital asset is transferred, tax rate is flat 10%. On or after 23rd July, if capital asset is transferred, tax rate applicable is 12.5%. Long-term capital gain under section 112. Rate of tax long-term capital. See, before 23rd July 2024, there is concept of indexation. But on or after 23rd July 2024, there is no concept of indexation. So before 23rd July 2024, if asset transferred is listed securities other than a unit or a zero coupon bond, then like long-term capital gain under section 112. Before 23rd July 24, on or after 23rd July 2020. Okay, so before 23rd July 2024, if capital asset is listed securities other than units, zero coupon bonds. For these two options are available. What are two options? Claim indexation benefit, pay tax at the rate of 20%. That is option 1. Second option, don't claim indexation benefit, pay tax at the rate of 10%. That is option 2. For other assets, two options are not available, only one option, claim indexation benefit, pay tax at the rate of 20%. Okay, on or after 23rd July 2024, any capital asset, if it is long-term capital asset, then don't claim indexation benefit. Indexation benefit is not available on or after 23rd July 2024 and you are required to pay tax at the rate of 12.5%. You are required to pay tax at the rate of 12.5. But there is one exception. So we can conclude on or after 23rd July 24, if there is a transfer of any long-term capital asset, indexation benefit is not available on or after 23rd July 2024 and you are required to pay tax at the rate of 12.5%. Only in one situation, indexation benefit is. Shall I tell the exception? Everybody, shall I discuss the exception? Shall I tell the exception? Exception. Four conditions are there. First condition, SSC should be resident individual or HUF. Only for resident this benefit is available. Second condition, capital asset must be immovable property. Condition 3, it should be purchased before 23rd July 24. Condition 4, it should be transferred on or after 23rd July 24 or after 23rd July. If all these four conditions, what is the conjunction? Conjunction is and. All the four conditions are required to be satisfied. If all these four conditions are satisfied, then If all these four conditions are satisfied, while calculating long-term capital gain under section 112, okay, full value of consideration, you will not claim indexed cost of acquisition. Indexed cost of acquisition is not allowed. Only cost of acquisition will be allowed. Okay. And you will calculate long-term capital gain under section 112. This will be included in total income. Included in total income. Listen till the end, you will get complete clarity. I think you have already listened to this concept in amendments class or in booster lecture. Now, but while calculating tax, while calculation of tax on long-term capital gain under section 112, then two options are available. Option 1, claim indexation, tax at the rate of 20%, or option 2, don't claim indexation, tax at the rate of 12.5%. Out of these two, whichever is beneficial to the SSC, that will be whichever is. So I can conclude one point. On or after 23rd July 24, if resident individual or resident HUF, if they are transferring immovable property on or after 23rd July 24, they can still claim indexation benefit while calculating the tax. Able to understand? So generally, after 23rd July 2024, there is no concept of indexation, even though asset is long-term capital asset, except in case of resident individual, resident HUF. So even after 23rd July 2024 also, if capital asset is transferred by resident individual or resident HUF and that capital asset is immovable property, if it is purchased before 23rd July and transferred on or after 23rd July, if all these four conditions are satisfied, then exemption is available under section 54. Exemption is available, exemption, then indexation benefit is available even after 23rd July 2024 also while calculating the tax sum. Are you able to understand? See, when you are calculating total income, indexation benefit is not available. In total income, indexation benefit not available. But in calculation of tax liability, indexation benefit is available. Are you able to understand? That is the concept. So are you clear with regard to tax rates? Sharon, buyback, short-term capital gain. Short-term capital gain under section 111A. Before 23rd July 24, tax rate is 15%. On or after 23rd July 24, tax rate is flat 20%. Short-term capital gain other than 111A, normal tax rates are applicable. That means either default tax rates or optional tax rates are available. So that's it. We also had 1.5 hour session in the afternoon. Current buyback, this is small concept. You can watch booster lecture or you can watch revision lecture, hardly 10 to 15 minutes. Please watch that. So all important concepts in capital gains are completely covered in this revision. If you want to ask anything, you can ask. Because I have some client calls at 7 o'clock, I have final revision class also. I have to wind up. Preparation tips. Yes. First of all, minimum 3 revisions you should do. Without doing 3 revisions, you should not go to examination. If you go, high chances that you will feel examination as. Secondly, you should solve as many problems as possible. If it is CA inter exam, definitely he will test your conceptual knowledge. So you have to prepare very conceptually every concept. You cannot take light. If it is CMA exam, okay, fine. He will not go to very in depth, but CA exam definitely he will go. So let's do one thing. Actually, from tomorrow for next 3 days, I need to go out of my place uh, because like funeral is there. Again, shall we conduct PGBP on Monday? Is it possible? From Monday onwards, I will give schedule. As per that schedule, every alternative day I will take class for CA Inter as well. Is it fine? Hello, are you there? Okay, thank you. Special thanks to Charan, Sinduri, Usha, and there is another guy, Gokul Sai. I don't know whether he is listening from morning. Special thanks to these three people. They are listening and in live chat also they are participating very effective. Thank you so much for your cooperation. Okay, let's again meet on Monday. Thank you. Bye. Monday class I will take live from Hyderabad. Abhi to I am in Vijayawada, but from 4th, which is Monday onwards, I have a new batch. CA Inter, CMA Inter new batch at Lakshya, Hyderabad. Okay, bye. Thank you. If you have any doubts, you can ask in Telegram group. Not a problem at all. Okay.